Hello, everyone. In the previous videos, I walked through this DCF model, basically based on our projected financial statements. We calculating what is the projected unlevered free cash flow, which is a proxy that we can use to represent for companies' potential values. And then we bring all those projections back to today using the weighted average cost of capital as a discount rate to calculating what is the company's enterprise value, which is the total value that we believe based on our model assumptions, projected financial statements. And eventually we calculated the estimated shares per share. So let me just go ahead and basically plug in the original value. Otherwise, like you look at the different result here. So what I'm gonna do here is like I'm gonna just temporarily plug in those values here. This is actually the value I took out when I do the scenario analysis. But here I'm gonna just add it back to demonstrate the sensitivity analysis. So basically in this video, okay, so this will be the result here. Okay, there we go. So basically in this video, I will just show you how to conduct the sensitivity analysis, meaning that I know for the DCF model, we derive the intrinsic stock price there. But again, the reason we derive the stock price is basically based on a lot of assumptions that we've been making or we made throughout this whole process. But for this specific tab here in the DCF model, so the reason we end up with these two methods is because apparently we use two separate methods to calculating the terminal value. And each individual method here, we basically also made assumptions there. For example, the perpetuity method, we assume the long-term growth rate is going to be 3%. But in the real world, we don't know what's going to happen. So what if it's a 5% or what if it's lower than our expected? So it would be nice to check how this intrinsic stock price is going to change, how the enterprise value is going to change, and eventually we're going to be able to find out whether we're going to make money or lose money by comparing model implied share price with the current share price. Okay, same logic here for our terminal value using the EBITDA method. Apparently, we're using the 2020 EV to EBITDA multiples, but what if that is not what's going to happen after 5 years? Remember, this is the multiple that we calculated in 2020, but we use that as a proxy for 2025 exit multiple. So what if that is lower or what if this is higher? And also remember that we use the WACC to basically calculating the present value for next 5 years free cash flow and also the present value for the terminal value. And what if our estimation for the WACC are different? You guys did a stage 3 project for Tesla. You notice that for some of you guys who research online, you're gonna realize, well, people show, or at least the WACC showing on Google is different from the WACC that you estimated. Then how that's gonna change our intrinsic stock price? So that is the whole point for this sensitivity analysis. Now let's just break down this sensitivity analysis for two parts. One is for based on the result we derive using the perpetuity method, meaning that we're going to focus on this column. And the second one, we're going to focus on this column. Basically, we want to estimate how the enterprise value, the share price is going to change if we're changing certain parameters here for our model. So first of all, let's take a look. Under the perpetuity method, basically, I set up 3 tables here. And again, you don't have to set up your table always this way, meaning that apparently what I did here is like in this row, I put up different scenario for the terminal growth rate. In our model, we use a 3% here, but what if it's 2.5? What if it's 2%? What if it's like all the way to 4%? Of course, the higher the percentage, the higher the value you're going to get it, because this is the growth rate for free cash flow projections. As I mentioned in class, normally 2 to 5% is a reasonable range for this long-term growth rate. But again, what if it's not 3%? How does like active value, enterprise value going to change? How the share price going to change? And comparing to the current share price, whether we're going to make money or we're going to lose money. And also in the same time, we want to see that what if also the WACC is changed? Is WACC is not the same as the one we derived in our models here? What if it's lower or what if it's higher? How this going to impact the enterprise value or the share price? And again, as I mentioned, since I set up my table this way, then I'm going to demonstrate it to specify certain input in that Excel functions. If you set up in a different way, let's say if you put your WACC in the rows here, you put your terminal growth rate in the column here, then you have to just changing the input for functions a little bit. Now let's get started. For enterprise value here, apparently inside this table, we basically gonna recalculating the enterprise value as the one we did it here. Or more specifically, this was one after mid-year adjustment. We want to see if the terminal growth rate is 2% and the WACC is 5%, what is the enterprise value? If it's 2.5%, and if the WACC is 6%, what is the enterprise value? So basically, the sales inside this table, we basically just recalculating the enterprise value after mid-year adjustment for different combinations of terminal growth rate and the WACC. Apparently, you can solve this one by one, but which is not efficient. So in Excel, there's a functions called data table. We can solve all those values all at once. But that's going to require you to calculating whatever the value you want to solve inside the table directly. When you solve this, you have to including or link to the changing parameters in this table. So here, what we're going to do here, first, we're going to link this perpetuity method derived enterprise value after mid-year adjustment to the top left corner. So the reason we're doing this is because you have to tell Excel what is the reference. So basically, this reference cell tells Excel that inside this table is going to be the enterprise value, like the one we solved here. Now we just have to highlight the entire table area, go to top, click data, what if analysis, and then data table. So for the data table, this is the part I mentioned. It really depends on how you set up your table. So apparently, I put the long-term growth rate or terminal growth rate in the row. So that means this row input should be a terminal growth rate. And I put this different WACC in the column. So that means this column input is going to be the WACC. And specifically, since at the beginning, we gave Excel a reference value for this table, which is this terminal value. So basically for the input here is we have to input, like for example here, the terminal growth rate that you used to solve this reference enterprise value, meaning that that's going to be the one linked here. This will be because this is the cell we used to solve this enterprise value, which we linked it here. Same logic here. Then the WACC, since we list out the WACC in the column. And again, let me remind you again, in exam, you're going to find things setting up differently. So do not assume it's always the case. You put the WACC in the column and the row in the as the growth rate, okay? I mean, changing things. So now, since I set up this column, the WACC in the column, that means this will be the WACC that I used to solve my referenced enterprise value. If you click OK now we have a table. Basically, again, inside this table, you see this how enterprise value changed. If the WACC is decreasing, and even with the lower long-term growth rate, we still end up with a higher enterprise value. So you can tell how significant the WACC can impact this enterprise value calculation, okay? And apparently, if the long-term growth rate is high, WACC is low, we're going to see a significantly bump for this enterprise value, which is also makes sense just based on the math. Now you have the enterprise value. Then next table, we want to basically doing the same thing, but instead of estimating the enterprise value, we want to estimate this like intrinsic stock price. So we're going to link this one from the perpetuity method. This is the share price. Now we're going to do the same thing. Again, highlight the entire table area. Go to top, click data, what if analysis, and data table. So here, let me repeat again. Since I list out my terminal growth rate in the row, that means my row input is going to be this terminal growth rate. I list down my WACC in the column, so the column is going to be a WACC. So specifically for the row input here, I'm going to have to go back to link this 3% cell because I use this cell to solve my share price. And same logic as the WACC here. I use this WACC, the specific cell E43, to solve my share price here. If I click OK, now I have the share price. So same findings here. You're going to find out, of course, if the WACC is low, you're going to end up with a higher intrinsic stock price. If the growth rate is high, you're going to end up with a higher intrinsic stock price. So the one I circle in the middle here is basically this is the value we derive in the model. And everything else are basically just changed as we change the parameters here. And the last one in this table, we want to calculate in comparing to the current share price, which is actually given here. We want to see, eventually you're going to make an investment decision. So now you have all different combination of terminal growth rate and the WACC. Now we want to see under what scenario or under what combination of these two parameters we're going to be able to make money or we're going to lose money. In other words, to say that is like under what scenario based on our model assumptions, is Amazon is undervalued or overvalued, okay? So for this one, we can't really using the data table, but apparently if you set up with one formula, you can basically do exactly the same thing for everything else. So basically what we're gonna do here, we're gonna just comparing the model derived intrinsic share price, comparing that with the current share price and the -1, and you get a result, meaning that if this is the intrinsic stock price, basically now the Amazon price is overvalued by 54.49%. In other words, if you believe this is the Amazon share price value, then if you made an investment, you're basically going to lose 54. This is going to be your negative return, 54%. Okay. So now apparently we're going to compare this price one by one with the same current price using the same formula. So then let's just go ahead and anchor this denominator, and then we can just copy and highlight the entire table. You can use your mouse or a keyboard shortcut. Basically, we're gonna do we're gonna copy the formula and the number formatting, and then take a look. Apparently, this is what we get from the model. So based on our model assumptions, we end up with the $1,063 a share, which is a 69.01% discount comparing to the current price. So you see, based on our assumptions, apparently only one scenario or one combination of terminal growth rate and WACC going to give us a positive return, which is when the WACC is 5% and the long-term growth rate is 4%. Other than that, all other different scenario here, you're going to lose money if you invest the money into the stock. But if you think from the other side, then probably this is going to tell you now Amazon is way overvalued based on your model assumptions. And then probably this is a good timing to starting to short Amazon price. Is because due to the efficient market hypothesis, eventually the stock's value should fall back or converge to its intrinsic stock price. So meaning that if you believe that would be the case, so you can starting to short stocks, meaning that you can borrow the stock and sell at the 3,432. And one day if Amazon do decrease down to 1,063.88, that means you're going to make a profit by whatever the percentage here, but instead of is negative, it will be a positive. Okay. So I hope you get the idea. Basically, the sensitivity analysis just give you, or we try to assess how this equity value, how the enterprise value, how the share price gonna change if we're changing certain parameters in our model. Okay, same idea. If we move to the EBITDA method here, we're gonna do the same thing here. Apparently now the parameters change. Instead of using the terminal growth rate or change the terminal growth rate, we're gonna change the exit multiples. Remember, we're calculating this exit multiples by using 2020 financials. And what if, like based on the projections, this is low? So what if it's a 40 times? What if it's a 50 times? So things gonna be different. Okay. So for this one, we're gonna do the same thing. So basically, we're gonna link this equity value under this EBITDA method here to the table, because this is the reference value you're gonna give to Excel. That means inside this table going to be enterprise value using different combination of exit multiples and WACC here. So now let's highlight this entire table, go to top, click what if, data table. Same logic here, since I list out the exit multiple in the row. So this will be a multiple that I used to solve this enterprise value. So that means that will be this 36.7, or specifically the cell E49. And then for the column input here, since I list out my WACC in the column, then we're going to just go back to link the WACC that I use to solve this enterprise value under the EBITDA method. And now if we click OK, you get this table done. Okay. So I know I've been keep saying this. Let's just change this a little bit. What if I'm going to change the row to WACC, and I'm going to change this column to exit multiple. Okay. So meaning that basically I'm going to delete all of that. So what I'm going to do here is I'm going to just set up the different scenario. Oh, I'm sorry, set up a different scenario for I'm going to set up my WACC in the row here. Okay. So that's going to be 5%, 6%, and then we have 8% and 9%. And then I'm going to leave my exit multiple in column. So now you do have to change your row and column input in that data functions to make it in the correct way. So now let's, for this one, let me just go ahead. So meaning that that's going to be 20 times, 30 times, 40 times, and 50 times. Okay. So now say if you take a look at, I'm going to delete this one. If you take a look at the setup differences here for this table compared to this table with this table, apparently now I can change the WACC to the row here and change the multiple to the columns. And the way to solve this table can be the same. So you're going to link to this enterprise value. But now let's just highlight this table area, go to top, click what if and the data table. So now apparently I change my row as the WACC and the column as the multiple. So meaning that from, if you set up your table like this way, the row input is gonna be the WACC that I use to solve this reference value, reference enterprise value. And then for the multiple, now it becomes to the column input. So that'll be the multiple that I use to solve this reference enterprise value. Click OK. You get the same table in a different way. Okay, the value are exactly the same as the one we solved before. It's just like the position for that cell, it changed because now we changed the row and the columns here. So I hope you get ideas there. Okay. Now let's move on to the next one. What if we want to calculating the shares price? So same idea. If Excel reference value for this table, this is equal to the share price we derive under the EBITDA method. Now let's highlight the table area, go to top, click data, what if analysis, data table. So for this one, let's take a look, comparing to the one above. Apparently the setup are different, right? I set up my EBITDA, the EBITDA multiples in a row. So meaning that this row input is gonna be the multiple that I used to solve this intrinsic share price. And then the column input now becomes to the WACC. So that will be the WACC that you used to solve that reference share price. Click OK. Now we have the share price. So the last one, we're going to do the same thing. Let's just link this one. So this is the current share price. Let's compare. If we're changing different multiple with the WACC, how this going to give us? Like, are we going to make money? Or we're going to, or it's like, is it going to be overvalued or undervalued? So this is going to equal to the share price we derive here on the top and divided by current share price. Let's anchor that -1. And apparently this one tells us, yeah, if this is the case, if the exit multiple is 20 times, the WACC is 5%, basically now the share price is being traded is overvalued. If you invest money, then it's going to lose money. Okay. And then we can just copy and paste the formula. Now you have everything. Oh, I'm sorry. Calculated. And now let's take a look. Apparently, based on the exit EBITDA multiple method, we can see that pretty much if the multiple is above 30 times, then you're always going to make money, meaning that that is going to tell you Amazon is undervalued. Okay. But if it's 20 times your exit multiple, then you're going to lose money by comparing to the share price has been traded currently. So I hope this gave you some idea. Apparently, this sensitivity analysis, you can be creative to testing all different factors or drivers may change your model value, the enterprise value and the share price basically the goal here is we try to assess, like what if we are wrong? What if the WACC is not 722? What if this is not 3%? Then how our model going to change? Are we still going to be able to make money? Is that mean the stock's still going to be undervalued or overvalued? So this is the goal for the sensitivity analysis. And this will conclude this video. And next video, I will work on the scenario analysis. And eventually we're going to talk about the football field chart, which basically just use a visualization method to visualize all the projections from our models. Okay, so this is it for this video. Let me know if you have any other questions. Bye.